Hello, YouTube. The stock market just did something it hasn't done in 25 days, which is actually close green, but notably close over the previous candle high. We've not done that going back to October 6th, and now we just did that today. Last week when we had this dead cat bounce, it did not really lead to much. The next day we close lower, so that's really different. And secondly, on the weekly chart, we're actually closing to the cent on 418.5. So is it time to flip? Because Jerome Powell is going to be talking tomorrow, and maybe he's going to say interest rates are just too high. It's also really important for us to note that the monthly chart is also now closed out, and it closed out bearish. So flip, flop, we're going to go through and talk about all those different words for the rest of the week and the rest of the month. The most important areas for me are just going to be two levels. The two levels I'm watching for going into the new month, meaning November, is either going to be, do we get back above 423 for any momentum, or do we lose 409? If we do manage to actually advance from here, it could set up an inverse head and shoulders, but to be honest, the monthly chart is kind of busted. The onus is on the bulls to kind of fix it now. So that's why we're looking to the weekly chart. We're trying to find this chart that we can support our story with. And right now, because we're to the cent on the 50 weekly, and the daily chart tells us that last time when we weren't able to rally, well, this time it looks like we're trying to. Keyword being trying. So we're going to go through and talk about all that. And honestly, we talked about flop, which means go lower. And I'm not sure what Jerome Powell is going to do tomorrow. On the weekend, I went through and talked extensively about what I'm looking for. So I'll encourage you to go and watch that today. If we look here to the one-day performance, it's actually pretty good because look at where the S&P is on the week. The S&P is currently up by 1.8% on the week. So the fact that things aren't that red is actually pretty good. If we look here to the last 4 hours or the afternoon, most of the gains came in the morning, which means that stocks got bid up all morning. And then in the afternoon, we flatlined, which means people are kind of on edge going into Jerome. Why? Man, it's been bloody. Look at the last week. It's mostly red, unless you're Amazon. And looking at the last 1 month, hey, it's pretty much red for everyone. Unless you're Microsoft or Amazon, there's not been very many places to hide. We can also note that we are still in fear. We're currently at 31. Yesterday, we are at 30. And what's so important about this is that we've not actually closed below 25, but there was also a period where this was actually not tracking. So I'm going to take this with a grain of salt. But a year ago, back in October, we went into extreme fear, and then it was a slingshot higher, hit extreme fear, slingshot higher. Now we have extreme fear, dead cat bounce, and now we're not sure. We have to make it to at least 36 on a closing basis. And we're getting closer, but we're not there yet. Is it going to happen tomorrow? Well, 36 is nice, but for us to confirm a move higher, we're probably going to have to get back to about 45 or 46. We're back into neutral. That would likely also correspond with probably a weekly higher high. As of right now, all we have is an inside bar, which just means we're pausing. So if we're pausing, what's the dominant trend? Well, in case you've been living under a rock, it's down, dead cat bounce, down, dead cat bounce, and down. What does that mean? Well, we got 3 nasty cuts, just like the seasonality chart says. But with an inside bar, the bulls still have a lot of work to do. All right, I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up and subscribing to the channel, that would be greatly appreciated. And I'll thank you ahead of time because you guys have just been such a great audience. All right, so we talked about extreme fear, and we're going to have Jerome Powell talk tomorrow. But what's going to be even more important for me before that, maybe not more important than Jerome, but probably equally as important, is I made a joke about Jerome about whether or not interest rates were a little bit too high. And we're going to find out tomorrow. Why? We have a T-bill auction, which means the government's going to be auctioning off T-bills or basically bonds. How much? Tomorrow, they're going to be selling a cool $56 billion. And then what day is that going to be? On Thursday, they're going to be selling a cool 95. And then they're going to be selling a cool 85 billion. So in the next 2 days, they're set to sell. Let's pull out the quick calculator and see exactly how much the government's going to be selling, because it's a pretty big number. 56 plus 95 plus 85. That's only $236 billion in the next 2 days. That's a casual $250 billion. Man, I don't know what's going to happen. So what I'll be paying attention to is what happens to the 10-year note, whether or not it does actually get back above that 5% threshold. And what Jerome's been saying is that by having long-term rates go higher, it's doing part of the work for the Fed. but it's not doing it for the reasons that we would like. It's because the government is broke. They failed massively. And what they failed to do was to lock in long-term rates. I read this article yesterday, and I respect Stanley Druckenmiller quite a bit, so I'm just going to show you this headline here. Kind of forgot about it before I hit record. Stanley Druckenmiller slams Janet Yellen for not locking in long-term rates. Calls it the biggest blunder in Treasury history. Why? Man, they could have been selling these things at like 1%, maybe 2 for a long term. These are going to be 17-week and 4-week and 8-week T-bills, which means they're not going to be all that long. The longer issuance is going to be coming in on the 7th and the 8th and the 9th, where they're going to be selling 3, 10, and 30-year bonds. If this confuses you, all it means is that this line keeps going higher because the government keeps selling more and more debt. So what are people doing? They're commanding a higher premium. Just like if you don't pay off your Visa, what does Visa say? Well, your interest rate goes up. So that's what happens when you don't pay. You become delinquent. They don't trust you as much, and they want to get paid more. So that's what investors want. And Jerome is happy the rates are higher because it's doing the work for him. But I don't think he's going to be very happy with the results. So let's go through the economic data that came out today, keeping in mind that Jerome's going to talk tomorrow at 2 p.m. Sorry, 2:30. We get those headlines coming out at 2 o'clock, the statement, the interest rate decision. And then the big man comes on stage at 2:30, usually talks for about an hour. And this will be important because we have more data coming out on Friday, which is going to be the unemployment rate and non-farm payroll. All right, so we got some constructive numbers today. CPI in Europe came down to 2.9. That is pretty low. That's pretty nice. Previous reading was 4.3. It's surprised to the downside. That's why it's red. And let's look and see how Germany shaked out today. That's the market I like to look at for direction. So the FDAX, which is just the futures for the for DAX, we're up by about 0.6% today. Hey, that's pretty good. And then we can note that we got consumer confidence coming out today as well. But another number, if we drill down a little bit further, down to 2 bulls, this is actually what caused the volatility this morning, in case you weren't sure. So last night we were mostly green. Wake up this morning, we're red. Now we're closing green again. Man, the market needs to decide which way it wants to go. As you guys tell me in the comments every single day. Captain Flip, Flop, and Flapjack. There we go. Employment Cost Index. This is the number here. So the Employment Cost Index, or the ECI, went from 1.0 to 1.1. And that'll be important because this week, I believe we get average hourly earnings. Yeah, we do here. So average hourly earnings are also expected to tick higher. And this can kind of be seen as a preview for that Friday number. Just like the ADP non-farm payroll has been a preview for the non-farm payrolls coming out on Friday. But has that number been accurate from ADP? Nope. It's also not something that a lot of people track as much anymore. They're redoing the way they do it, but this number has not been very accurate. So maybe that's why that ECI, or Employment Cost Index, number came out this morning. So that's what we have. It looks like the Fed is really messing up. And looking here to the unemployment rate, I think this is going to really matter coming in on Friday. Let's actually see if those numbers got updated, because let me just refresh, because we were looking for about 3.8 and 172. Let's see what those numbers are now. So let's go this week. Let's go back to 3 bulls. Looks like it didn't save my preference. There we go. Apply. Thank you, investing.com. All right, let's look here. So we got 3.8 and 188. So I think that anything under 200,000 would be constructive. It would be better if this unemployment rate ticked up, and it would be better if this average hourly earnings ticked down. So I was unsure whether I was going to do a sell the rip today on the video, and it really came down to whether or not we closed above the 50 weekly. We closed on it right to the cent. So honestly, I'm not entirely sure. I went through and talked a lot about a bear thesis on the weekend. So if you want to learn more about that, that should now be queued up here on the left-hand side. If not, you can subscribe to the channel on the right-hand side. I very much look forward to seeing you tomorrow, and I wish you all the best of luck into Powell and the FOMC. Thank you again. I will see you tomorrow.